Welcome to the TrustleBridge Capital monthly video series entitled Asking for a Friend. I'm your host, Eric Jefferson, and for this month, we explore a theme that's taken place given the significant outperformance of some of these mega cap AI themed stocks that has led to a historic level of concentration within the S&P 500. We're going to take a look at not only what that means, more importantly, what are those implications as we get a little further into the business cycle. Now, before we get started, I have a few quick words from our legal team. So with that, let's begin. I want to start by first defining the S&P 500 index composition. There's two versions of it. The one that most investors are familiar with refers to the cap weight version, where a individual stock's percentage of that index is a function of that company's overall size, as opposed to, you see outlined in the right-hand column, a equal weight index where each of the 500 largest companies have an equal weight of 0.2%. Now, with the trends over the last decade, especially over the course of the last year, where you've seen a lot of these mega cap technology names just continue to grow and grow and grow, they now represent a much larger percent of that overall index. You can see here top 15 names in the S&P 500, a good number of those in the technology space, and again, collectively, those companies now represent 37.5% of the index as opposed to just 3% in the equal weight version. Now, over the last century, there certainly have been periods where the largest companies get larger relative to some of the other names. One way to sort of capture and illustrate this is we look at the market cap of the largest stock relative to the market cap of the 75th percentile. As you can see here, this has happened before. We need to go back, though, nearly a century to the beginning of the 1930s before we arrive at comparable levels. Now, the question ultimately is, what does this mean for markets? Now, as you would expect, where the largest companies have gotten larger, therefore represent a larger portion of the underlying index, not surprisingly, as we look at the last 5 or so years, the impact of those 10 largest companies has been much more significant relative to the other 490 versus where we've been in prior periods. We have this illustration here from Goldman Sachs. The light blue represents the market contribution from those 10 largest stocks, the dark blue from the other 490. Again, a perfect example, we look at a year like 2014, the 10 largest stocks contributed just a fraction of the overall return. We look at a year like 2023, and you can see almost a third of the index return came from just 10 stocks. So the question ultimately at the end of the day is this good or bad? Now, two things I would encourage investors to keep in mind. The first is anytime an index has extreme levels of concentration, that inherently now offers less diversification. Again, if you're investing in an ETF that gives you exposure to 500 companies, you're likely doing so to avoid any company-specific risk. Boeing and their struggles as of late is the perfect example of why you would want to diversify away from a strong sector, but a company that came with many risks associated. Now, obviously, where 40% of the index is represented by 15 companies, you now have greater idiosyncratic or company-specific risk when we think about that holding in your portfolio relative to prior periods or even an equal weight version where each company is given the same amount of influence. Again, is that good or bad? The answer is that ultimately depends. As those larger companies perform, so does the market. In a upward trending market, similar to what we've been throughout all of last year, those large names tend to lead the market higher. Again, that is a scenario where owning a cap weight version worked out in your favor. You had more exposure to those bigger companies that grew even bigger relative to the 490 others. However, there is a cost to that, and the expense is when those stocks underperform, they tend to lead the market lower. And so that excess return tends to be much lower in down volatile markets. Now, certainly, we're at a very pivotal point here. 2022, very difficult year, both stocks and bonds down sharply. 2023, we saw a lot of those mega cap names rebound, especially at a much faster rate than the average stock. As we get into 2024, that trend is one we watch on a daily basis. Certainly, there are a lot of positive catalysts and tailwinds for the AI names continue to grow. That's a thesis to maintain that cap weight exposure. Obviously, though, those companies are becoming a little expensive when we think about the price where they trade relative to the earnings that they generate. And taking more of that diversified approach may not be a bad idea. Again, at some point, if markets get spooked, generally investors tend to sell those winners, redeploy capital to some of those lesser performing names. We are starting to see a little bit of that trend, which is why we think today is a perfect opportunity to stay invested, but with that cautiously opportunistic approach. Now that's all for this month. I hope this was helpful. As always, if you do have any questions as well, if there are topics you would like to see explored further, please don't hesitate to send those directly to myself. You see our contact information there. Thank you and have a great rest of the day.